They say the stock market is a mirror of America's dreams, glittering, turbulent, unpredictable. But beneath the flashing numbers and breaking headlines, a hidden story unfolds every second. A tale of power, ambition, crashes, and comebacks. Today, we dive deep into the veins of American finance to discover how the U.S. stock market truly works and how it's evolving right now before our very eyes. Before we begin, if you love powerful stories that unveil the soul of America, make sure to like this video, subscribe to Timeless America, and tap the bell icon so you never miss a journey into the heart of history, economy, and ambition. The story of the United States stock market is the story of America itself, bold, chaotic, aspirational, and ever-changing. It all began almost humbly at the end of the 18th century. In 1792, 24 men gathered beneath a buttonwood tree on Wall Street and signed the Buttonwood Agreement. They could never have imagined that their small pact would someday evolve into the world's most influential financial marketplace, the New York Stock Exchange, NYSE. Back then, the market was simple. Buyers and sellers meeting in person, exchanging bonds and a handful of stocks, their futures hanging on handshakes and trust. Fast forward to the roaring 1920s. Jazz filled the air, speakeasies buzzed with forbidden laughter, and the stock market danced upward. Ordinary Americans, convinced that stocks were their ticket to wealth, poured their life savings into shares. Margin buying, borrowing money to buy more stocks, became the fashion. Euphoria blinded prudence. Until one crisp October morning, in 1929, everything changed. The great crash struck like a thunderbolt. In just a few days, fortunes were obliterated, banks collapsed, and the American dream crumbled into dust. Wall Street's towers of hope became tombstones of despair. Families, who had dreamed of riches instead lined up for bread. The government, wounded but wiser, responded. In 1934, the Securities and Exchange Commission, SEC, was born, designed to regulate and police the market. Rules were laid down. Companies had to disclose their financial truths. Insider trading became a crime. Transparency became the new language of finance. And the market began its long, slow crawl back from the abyss. Through the decades, America's stock market evolved, always reflecting the spirit of its people. In the booming 1950s, fueled by post-war prosperity, Americans fell in love with stocks again. Mutual funds grew. Retirement plans like the 401k transformed middle-class workers into stockholders. The 1980s witnessed a new revolution, the rise of computerized trading. Suddenly, trades could be executed in milliseconds. Wall Street wasn't just a street anymore. It was an idea, a network connecting the entire globe. And yet, risks grew in the shadows. In 1987, Black Monday struck. The worst single day. Percentage drop in Dow Jones history. No one saw it coming. The crash exposed how tightly computers, psychology, and volatility had become intertwined. The SEC rushed to install circuit breakers, designed to halt trading if prices fell too fast. The 1990s brought the internet boom. Companies like Amazon and Microsoft lit up the markets. A generation of day traders emerged, chasing quick profits, with wide eyes and faster fingers. The NASDAQ, a technology-heavy exchange, soared into the stratosphere. But the new century opened with a gut-wrenching collapse. The dot-com bubble burst in 2000, wiping out billions of dollars overnight. It taught a brutal lesson. Profitless companies, however shiny, cannot defy gravity forever. Yet even that pain was just a prelude. In 2008, the world watched in horror as giants like Lehman Brothers collapsed, triggering the worst financial crisis since the Great Depression. The housing bubble, subprime mortgages, complex derivatives, the entire system buckled under its own recklessness. Millions lost their homes, their jobs, and their faith in Wall Street. To save the market and perhaps the nation, the government unleashed massive bailouts. The Federal Reserve slashed interest rates to near zero. Quantitative easing, printing, money to buy government bonds became the new normal. Critics cried foul. But slowly, painfully, the stock market rose again. By the 2010s, a new phenomenon was reshaping the market: passive investing. Instead of trying to pick winning stocks, millions of investors began pouring their money into index funds, simple, low-cost funds that tracked the entire market. Companies like Vanguard and BlackRock exploded in size, changing the very DNA of Wall Street. Today, trillions of dollars sit in passive vehicles, making the stock market less volatile on some days and far more fragile on others. And then came the pandemic. In early 2020, COVID-19 crashed into the global economy like a runaway train. Within weeks, the S&P 500 fell by over 30%. Yet, in an almost surreal twist, the market rebounded faster than anyone imagined, turbocharged by government stimulus, low interest rates, and a new breed of retail investors who turned to apps like Robinhood. It was the era of meme stocks. GameStop, AMC, Bed Bath & Beyond. Stocks no longer rose on fundamentals, but on collective belief, fueled by Reddit boards and TikTok videos. David had found his slingshot against Goliath, at least temporarily. Hedge funds lost billions, and a new populist energy surged through Wall Street. Yet once again, reality demanded its due. Inflation, long dormant, awakened like a sleeping giant. By 2022, prices were rising at the fastest rate in 4 decades. The Federal Reserve slammed on the brakes, raising interest rates aggressively. High-flying tech stocks plummeted. Silicon Valley Bank collapsed in early 2023, sending shockwaves through the banking sector. Investors realized something fundamental: free money was over. How the U.S. stock market works. Today in 2025, the U.S. stock market stands at a critical crossroads. At its heart, the market is still a meeting place, a giant auction where buyers and sellers negotiate the price of ownership stakes in companies. There are major exchanges: NYSE, the older, more traditional exchange; NASDAQ, home to tech titans like Apple, Microsoft, and Tesla; and newer trading platforms like IEX, which promise more transparency and fairness. Each stock represents a tiny slice of a company's future earnings. Investors buy stocks, hoping that slice will become more valuable. If more people want to buy than sell, the price rises. If fear takes over and more people sell, the price falls. But modern trading is far more complex. High-frequency traders, algorithms operating at lightning speed, dominate daily volume. ETFs, exchange-traded funds, allow investors to buy entire baskets of stocks instantly. Dark pools, private exchanges hidden from public view, allow massive trades to happen without moving the visible market. And then there's the Federal Reserve. Today, interest rates are the highest they've been since before the 2008 crisis, hovering around 5.25% in 2025. The Fed remains cautious, warning that inflation could resurge if policy loosens too soon. Markets hang on every word spoken at Fed press conferences, moving violently with every hint of rate changes. Meanwhile, the rise of artificial intelligence is the newest force reshaping the stock market. In 2025, hedge funds and institutional investors use powerful AI models to predict market moves, analyze earnings calls, and even trade automatically. Some funds boast that their AI algorithms outperform human managers, but critics warn that too much AI-driven trading could amplify crashes, as machines might all react the same way during panic. Retail investors, ordinary people like you and me, now have more power than ever before, thanks to commission-free trading apps, vast information on social media, and AI-driven financial advisors, robo-advisors. But that power comes with new risks: scams, manipulative influencers, and algorithmic bubbles. In the latest update, the Securities and Exchange Commission (SEC) under Chair Gary Gensler has proposed stricter rules for market transparency, especially targeting payment for order flow, a controversial practice where brokers sell customer trade data to high-frequency traders. These new rules aim to make trading fairer, but could dramatically reshape how brokers like Robinhood operate. Meanwhile, corporate earnings are showing signs of strain. Mega-cap tech stocks, Apple, Nvidia, Google, still dominate the indexes. But small-cap companies heavily burdened by higher interest rates struggle to grow. The stock market in 2025 is a two-speed world. The giants continue marching upward, while smaller players fight for survival, and geopolitics lurks in the background. Tensions with China, especially around Taiwan and semiconductor dominance, threaten to disrupt global supply chains. New tariffs, technology bans, and strategic alliances are becoming the norm. The market knows that a single event, a spark, could send ripples across every exchange. Investors today must navigate a world of contradictions, a booming AI revolution but sluggish productivity, soaring corporate profits but widening inequality, globalization, slowing but still critical to markets, a financial system more accessible than ever but riskier in unseen ways. In 2025, the U.S. stock market is no longer just a reflection of the American economy. It's a battlefield of technology, psychology, and policy. Those who understand its pulse can ride its waves. Those who don't risk being swept away. As we stand here today, one thing is clear. The stock market is not a machine built only of numbers. It's a living, breathing organism, fueled by human hope, fear, greed, and genius. It is, in the truest sense, the story of America written in real time.